In this chapter, we're going to learn about the GDP and the differences between real and nominal GDP. Here's real and nominal. Basically, real GDP takes into account for inflation, so it removes it. It's the better measurement to use. Nominal includes inflation. And I told you earlier in class that the price index is basically going to be used to calculate inflation rates. We're going to learn how to deal with those as well. But as we open up this chapter, we deal with this term, national accounts. And the national accounts are really what's going to keep track of all these transactions, the flow of money between all the various sectors of the economy. And if we look back at that circular flow diagram, when we go back and look at the households, the firms, the government, and the rest of the world exporting, importing, we'll see that there are really three basic markets that we're focused on. The factor markets, where you get the labor, the capital, the resources, the markets for where the goods and services are purchased, and financial markets, borrowing money, transactions of monetary investments, and so forth. Well, the household section is going to fall under the C, the consumer spending in the GDP, and that's goods and services that we purchase in a given year. And obviously our money that we use to spend on those goods and services come from typically wages, although you will find income from stocks, bonds, anything else that generates profit. And just to kind of showcase, here's an example of a stock. This is Google. It's literally ownership of a company. And they do that, they issue stocks to raise capital, to raise money to invest and expand their businesses. And it basically says that you get one share of that company. And then we also have bonds. Bonds can be done in a number of ways. We see here there are municipal bonds. The cities, the towns can issue bonds, meaning that I borrow money and I base it off of some project that I'm working on that has a value, is an asset. And you would recall that the HYCC, the town took out a bond. That's where they get evaluated with their credit rating. Housing bonds do the same thing. I want to buy a home. I'm going to issue a bond. The bank is going to loan me money to go out and purchase that home because I don't have that capital at the moment. So there's a lot of other ways that bonds operate, but basically it's borrowing money with something as a collateral typically, although you will see that there are some bonds that are issued that are unsecuritized. So when you see securitization, meaning that it's secured to something. So if you default, they're able to recoup their money in some other fashion. In addition to the bonds and stocks, there are government transfers. Government transfers are typically money that the government pays out without purchasing a good or service. So for example, Social Security would be one such type of government transfer. The government pays that money out. It does not get counted. The money that the person receives will go out and use that to purchase goods and services. That's where it will get counted. So otherwise, it would basically be double counting. But government transfers refer specifically to that. Minimize that if I can. There we go. We also have disposable income. Disposable income is basically all your income that you take in, including government transfers, and then you subtract out the taxes. It's what's left over, and that's what you're able to spend on consumption and savings. And what we look at when we say private savings, it's whatever you don't spend. It's whatever money you save and put aside. That money is private savings. It's the disposable income not spent on consumption. This last part, number 8 here, is something you should pay attention to. Specifically, all of these things must equal the total flow of money. So whatever you spend in the private savings, the taxes paid should all equal the wages, the profits, interest, rent, and government transfers. And we'll see those in class later on through our formula. Transitioning, we look at the financial markets, and we're talking about government borrowing. And they borrow the money from the financial markets. So when the government wants money, they go into the financial markets and they ask for a loan. Businesses will give them loans. Banks will give them loans. It's happened over our history where we've been bailed out by banks. The government will also take in its revenue from taxes. It will go out and purchase goods and services, and that's where they buy the hammers, the computers, the employees, the military. They're spending a massive amount of money. On the other side, the international sector, we see exports and imports, and when you subtract the two, you get the net exports. It's the difference between the two. So this takes care of the government component of the equation, which, just to refresh, it's G plus C plus I plus X minus M. So keep that in mind, and we just looked at the G component. We've now seen the C component, and next we're going to look at the I component. Under this section, the business investment, what we're going to see here is that investment spending is spending on physical capital, machinery, construction, buildings, any supplies, goods that you need, and within that you're going to get inventories. That's where Mark Broad's question about a car that was produced in 2011 but gets sold in 2012, that would fall into the inventory category. That's unsold, and that's where we would account for it. And the gross domestic product is simply all those goods and services that we're looking at within that given year. One of the challenges that we'll face in this section is the intermediate goods. That's when my business goes and purchases something from another business that is needed in my production. So those are considered intermediate goods, and they get handled in a number of different ways, and typically are left out because it's the final product that we want to look at. So businesses have to be careful with their accounting to indicate whether that was sold to another business or if it was sold to an individual, because otherwise it could lead towards double counting. Here we're going to see the GDP per capita, and that's going to be a measurement that allows us to look at the average person and what their real wealth is, or what they're spending. Unfortunately, you will find here that it is not a sufficient measurement of human welfare or the quality of life, though we do look at it as a way to more accurately compare one country versus another country and see some of the differences in the GDP per capita and how much purchasing power that country really has. So even though it's not a sufficient measure, it can be a measurement of standard of living. Okay, we should be familiar with the price levels. And what we're going to see is the market basket is going to represent the average purchases a consumer would make. So it actually has percentages towards food allotments, clothing, housing, transportation costs, etc. And that's going to give us a price index. It's always measured in base of 100. And we'll see here, this is how you would calculate it. I'm going to give you a couple of examples. It will help us to measure the inflation rate for the consumers that measures the price level changes from a given year compared to a base year. So that's the CPI. There is a PPI, which is for the producers to measure their price or cost levels and the impacts that's going to have on the prices consumers pay. And lastly, this GDP deflator, which measures the price level changes for the economy as a whole. It does not separate out just the C. It measures the entire GDP. So let's look here at the first example. Sorry. So this is something that we can look at here and be able to tell what the difference is between the CPI and the GDP deflator. And you'll see here that the GDP deflator includes all items that make up domestic production. So it's more than just the consumer goods. And kind of a nice little way to see it differently, or look at the formula again for calculating the CPI, and you'll see it's the rate of price inflation for all goods produced in a nation if you would use the GDP deflator, not that one. So here's an example of a problem. So consumer price index, here's what happens. The labor of Bureau of Labor Statistics will create the market basket by compiling the consumer goods right here and services that were bought in a year. They'll do it on a monthly basis. So here's some examples. And what you'll see here is if we wanted to calculate the price index for the current year, we would do it by multiplying 100 times the spending current year divided by the spending in the base year. And so if you see here, 2001, we would see that worked out in this formula with 109.26. It's easy to tell what the base year is because the base year is always 100. So keep that in mind as we see other questions that we'll deal with, where it will give us the CPI and it'll ask you to identify the base year. It's easy, it's the 100.